So tell us, this is like your Super Bowl coming up this week, right?
I think the Super Bowl's next month, isn't it?
I'm talking about bank earnings.
Oh.
You know banks and this whole world of Wall Street better than almost anyone in the Wall Street Journal newsroom. And I really think of this as your moment to shine.
Well, I've been writing about bank earnings for years. So yeah, I feel like I'm ready for this one. But before we get into it, and we will, I want to introduce myself. I am Telis Demos. I write for the Journal's Heard on the Street column.
And I'm Gunjan Banerji, lead writer for markets here at the Wall Street Journal. And this is WSJ's Take on the Week, your favorite weekly show about investing and markets.
Each week, we bring you conversations with insiders and from inside the Wall Street Journal newsroom about finance, economics, all that good stuff.
So we have a really exciting conversation today. We sat down with Peter Orszag. He is the CEO of asset manager and investment bank Lazard. He was also in the room with the Obama administration. He served as the director of the Office of Management and Budget.
Well, the intersection of Washington and business seems like a hot topic these days.
Exactly. I mean, Wall Street is just so giddy about a Trump administration, and he was the perfect person to chat with about this.
Well, that's going to be great. But before we get into that, Gunjan, I want to talk to you about what's trending in the markets right now, and that is bond yields. Those benchmark 10-year treasuries, the kind of what everybody looks to for the long-term cost of borrowing. Those yields last week were hitting 4.7% plus, which to me is wow, because it wasn't that long ago. Last summer, fall, they were like a point below that. What is going on, and what is the conversation coming out of that?
I mean, it's so crazy. This is typically a really safe corner of the market. It's kind of considered a boring asset, right? Treasuries, not a lot of risk there. But this has turned into the thing that everyone on Wall Street is watching nonstop. And it's really remarkable to see bond yields rise after the Federal Reserve cut interest rates last month. That's pretty unusual, and it's left a lot of people on Wall Street scratching their heads.
Well, is that about inflation? And inflation is top of mind for me, not just because we've got the CPI coming this coming week, but also, I'm looking at what's happening in Los Angeles with the fires, and I'm thinking about obviously the human toll of that, but also what's going to happen in the insurance market. And insurance has been a driver of inflation. And so surely it's not going to get any cheaper to insure homes in California and other wildfire-prone areas. And is that going to continue to drive inflation? Is that on the mind of the bond market as those yields move higher?
So there's a few things going on. What this big sell-off in the bond market and this big jump in yields that we've seen is reflecting is strong economic growth. People think the economy is going to keep chugging along.
That's a good thing.
Right. That's good. There's a little bit of a negative in there, though, because that might come with higher inflation. Think about the tariffs that might be on the table. What is this next administration going to say about prices, about tariffs around the globe? The bond market is pricing in that uncertainty. And, of course, higher government deficits. Investors think that the government is going to keep spending, and that's going to keep those deficits really high. I do want to dispel one notion, though, when it comes to the relationship between bond prices and stock prices.
Oh, interesting.
Like a lot of times the past few years, the volatility in the bond market has trickled into the stock market. These higher yields kind of spook investors. They start to recalibrate where they're going to put their cash. But I was taking a look at some year-end data in terms of fund flows. And in December, U.S. equity funds recorded an 8th consecutive month of fund flows. Now, that's the longest
People
streak.
putting money into
Exactly.
stock funds. Wow.
People kept piling into stock funds for 8 consecutive months through December. Now, that is the longest streak in data going back to at least 2008. And what it tells you is that this higher interest rate environment we've seen over the past few years has not dented appetite for stocks. And I think that's just really important to keep in mind when you think about these higher bond yields.
Well, in other words, right, people are not being tempted by those yields quite as much. They're still willing to speculate on stocks. Well, one area of the stock market that has been very interesting to watch lately has been the media business and what's going on with streaming TV. And I just wanted to call out that, one thing I think is going to be very interesting to watch, especially as we get into the season when there is actual Super Bowls, not just Super Bowl bank earnings.
Not just your Super Bowl.
Not just Super Bowls for me, Super Bowls for everybody. The Disney recently struck a deal to combine its streaming Hulu and live TV service with FuboTV to offer a streaming sports element to that. The combined thing will be the second largest pay TV provider behind YouTube TV. I think that deal is interesting, and for a few reasons. One, although I should say, Fubo, by the way, was involved in some litigation with Fox Corp over a competing sports streaming service that will be settled as part of this deal. Fox, of course, shares common ownership with the Wall Street Journal's parent company, News Corp. But I think that that's going to be an interesting Disney, like other streaming, Netflix obviously has had a lot of success with streaming live events. Lately, it had that successful NFL game
Oh
on
my
Christmas.
God. What a production that
Sorry, I
was.
should say the Beyonce game.
Right. The
With some
Beyonce
football
concert.
mixed in. But that, by the way, those games, I just want to read a stat that I read in Dan Gallagher's piece in the Journal. He said that the live broadcast of those two NFL games on Christmas Day scored a big win, with the games averaging more than 24 million
My
U.S.
God.
viewers each,
That's
peaking at
insane.
27 for the halftime show, for Beyonce's halftime show. Those numbers broke previous streaming records for NFL games. So I think that the streaming wars are increasingly about sports and live events. Disney, of course, also recently paid $500 million to air the Grammys and stream it on Disney Plus and Hulu, and it also has like the Oscars and Country Music Awards. So streaming, not just about those prestige shows, but about events, live.
Right. I mean,
Sports.
sports, I feel like investors are really starting to view sports as kind of the next cash cow in terms of this space.
Yeah. Well, in sports news for investors, we, of course, have bank earnings coming up. JP Morgan will, as usual, kind of kick off earnings for many of the biggest banks: JP Morgan, Bank of America, Wells Fargo, Citigroup, Morgan Stanley, Goldman Sachs. They are going to be reporting their fourth quarter and 2024 year-end numbers. And I think it's going to be a very interesting quarter for a couple of reasons. One is that people are going to be looking for what the banks say they are expecting from the second Trump administration. It's expected to have a sort of deregulatory sort of vibe for banks. The head of bank supervision at the Federal Reserve recently announced that he was going to be resigning, and so that means that job will be open. So it'll be really interesting to see what the banks say about politics, I think.
Right. The animal spirits are back, and that will be on display this week.
Well, and absolutely, and as you called out before, people are excited about 2025 from a deal-making point of view. So I think people will be looking closely at the Wall Street side of big banks too. Big banks, of course, span both like lending to credit cards and businesses and things, but also do that deal-making. They advise on mergers. They bring companies public. They raise debt for companies. So I think that Wall Street part of the business will also be critical. And hence, very interesting to be talking to Peter Orszag, the head of an investment bank that does a lot of that deal making, Lazard. I know I read recently in the Journal that one of Lazard's competitors, another M&A advisory firm called Centerview, is thinking about, kind of raising money or doing some other transaction to sort of increase its own resources ahead of what is expected to be a pretty big boom for Wall Street in
People are getting
2025.
ready. Yep.
People are getting ready. Well, we're going to go to that conversation when we come back. We are thrilled to be joined by Peter Orszag. He is the Chief Executive Officer of investment bank Lazard.
And asset manager.
And asset manager.
Love it.
Both.
Okay.
Chief Executive Officer of investment bank and asset manager at Lazard. And there's really no one better to sit down with today to chat about deal making and the upcoming Trump administration. So thank you for being here today.
Great to be here.
So, Peter, I just wanted to set the stage first for the audience. There was a mergers and acquisitions and deal-making boom kind of during the post-pandemic or pandemic era, particularly 2021. We had Microsoft, Activision Blizzard. Blizzards. We had Discovery and Warner Media. We had a railway deal, Canadian Pacific and Kansas City Southern. We saw the SPAC attack, those special purpose acquisition companies out in search to just buy something, big-time IPOs, Roblox, Coinbase, Robinhood. Then things really started to slow down, especially in 2023. But now Wall Street seems to be excited again that those big boom times, I don't know exactly 2021, but something feeling big again is coming in 2025.
The animal spirits are back.
The animal spirits are back. What is getting people excited about 2025?
I think it's a few things. The first is the reason that you saw a significant downturn was that interest rates started the Fed was tightening, and that created uncertainty. It created a disconnect between buyers and sellers because if you think about a bunch of cash flows going out into the future, you have to discount those back to some value today. And as interest rates go up, it creates a disconnect because the seller wants to pretend that that's not going to be permanent, and the buyer's like, well, it's not worth that anymore.
And it's more expensive to raise money,
and
too,
it
right?
also
To
creates
finance,
financing issues. So you had challenges in the financing markets, and you had the biggest bad crowd come in and start to try to deter some of the deal activity.
Big is bad. You mean like the kind of antitrust concern?
Correct.
Okay.
So the biggest difference there was that, especially on vertical deals, the head of the Antitrust Division at the Department of Justice and at the Federal Trade Commission were adopting a new interpretation of how the rules should work. Now, the laws hadn't changed. They were just changing the interpretation. So you put that all together, and one thing that happened in 2021 that was also then not present in 23, say, is very active private equity, sponsors selling and buying. They were concerned about that disconnect that I talked about on the valuation. There were a whole variety of other things, and the financing markets were also affecting them. And so there just was not a lot of private equity activity. Gradually, you started to see the strategics re-enter the playing field as the interest rate increases topped off and then started to come down.
Strategics meaning like one
Big
company
companies,
buying
yeah.
another,
Yeah.
not like an investment firm. But
Correct.
Like, okay, yeah.
Correct. One company buying another. So that was really the story in 2024, along with other parts of, for example, our business. So just as one example, because private equity was not selling the underlying companies that it owned to the same degree, many of the investors in the private equity funds were saying, well, wait a minute, I need some cash back. And so there was a significant expansion. This is only one reason for this, but in the so-called secondaries fundraising business, where you're selling stakes in those existing companies and trying to kind of provide liquidity to the existing private equity investors.
So rather than actually like doing a deal and selling this business to another business, you're just sort of letting the investors kind of trade
Get
those
some
stakes
liquidity. Yeah. So
amongst
there was a lot of
themselves.
activity.
Okay,
That's
okay.
not the only reason for the
Yeah,
explosion
yeah.
in secondaries, but it was one. So now what you're seeing is the M&A cycle was building company to company, but private equity is also coming back onto the playing field because the financing markets are reopened, because those valuation gaps have narrowed. And so you've got a year ahead in 2025 that looks very promising. The regulatory environment is more promising. We could talk about that. The only debate that's really occurring is how quickly interest rates will come down. And that's an auspicious environment for financing markets and to avoid that valuation disconnect. Private equity is saying, okay, these are getting a little long in the tooth in terms of some of our holdings. We're going to be more active again. And you put that all together along with the underlying drivers that have always been there for deal activity. Ongoing technology revolution, the biotech revolution, the energy transition. I mean, there are a lot of things, the changes in supply chains that have arisen over the past few years. There are a lot of underlying drivers that are now meeting the moment of a more auspicious external environment.
Tariffs. How would tariffs impact deal making and the outlook
Okay,
here?
I'll come back to that in a second. But the first effect on inflation is that they are likely to be inflationary to some degree. It depends how extensive they are, how pervasive, what the level is. But directionally, they put upward pressure on inflation. So you've got these two different things where there's kind of a seminal downward trajectory, but then some new forces that might cause inflation to push back up. And I think the Fed's going to be watching the data and seeing which one of those forces dominates, and the path of interest rates is going to reflect that. Now, on tariffs specifically, on the one hand, a slower path of interest rate cuts is a marginal negative for deal making. I don't think it's a huge deal. I think the big thing is even stable rates at this point would create a lot of deal activity.
So there is this patchwork of different things at play, right? Some seem like they could be negative for inflation, for deal making, and others seem like they could be really positive. But tell us, I'm curious what you think of this, because when I chat with people on Wall Street, it seems like the mood is positive. So why is it that the overarching mood is so positive, given that there are these different factors at play?
Well, my view is that basically what's happening is M&A goes in cycles. It's been building, and the big piece involves that private capital piece, which is that, the amount of time that many portfolio companies have been held by private equity is getting a bit long in the tooth, and that's going to create a lot of activity. And then for the larger companies, the larger transactions, the regulatory environment is the big change. And there, you mentioned Microsoft Activision earlier. That's a really interesting example, because where Lena Khan and the kind of biggest bad crowd diverted the most from the sort of Bork traditional view of antitrust was in vertical transactions. That is not, one hospital company buying another hospital company, but merging up or down the supply chain. And that's what Microsoft Activision was. It was a vertical deal. Now, what's interesting about that case is the government lost badly. If you read the judgment in that case, the judge was harsh about, basically there are tens of millions of emails and documents, and there's not one shred of evidence that Microsoft in any of that documentation intends to cut out Sony or whatever the other fears were. So even during the biggest bad era, there was a changing dynamic in which the deterrent effect was eroding a little bit, because boards and C-suites were saying, you know what, we'll just take you to court. But going through the court process and the uncertainty and the expense and the time was definitely a negative. So that has been lifted to some significant degree, maybe not completely in tech, but in many other sectors.
Well, I'm glad you raised that at the end, because I did want to ask. And first, can you just explain I'm not an expert. I'm not a lawyer. Bork regulation. What is it? Is that referring to Justice, like going back to Judge Bork back in the 1980s? Okay.
The traditional view of antitrust, which was very much associated with Bork, was quite concerned about horizontal deals, especially among the top couple competitors.
Horizontal deals meaning like one store buys another
store.
Rather than
They're doing the
store
same
buys
thing.
A supplier.
Exactly.
Okay.
And was very relaxed in general about a store buying a supplier. And that is consistent with the consumer welfare perspective that was at the heart of that kind of theory of the case. The biggest bad crowd, though, has a completely different view. They're worried about size for size's sake. In other words, bigger companies are just harmful, period. So if a big company in the kind of traditional view bought another big company, that would be a problem if they were doing the same thing. If a big company bought a supplier and just got somewhat bigger, not something really to worry about. Under the biggest bad worldview, though, that's a problem in and of itself. That was the biggest divergence. And that's where I think you're going to see the biggest kind of going back to the more traditional, maybe not, it's not going to go all the way back, but a significant change.
Yeah, that's what I'm interested in, that perspective, because you mentioned, of course, Lena Khan, who was the FTC chair under President Biden. It's anticipated that there will be a new person in that job under Trump. And but there is a sort of populist element within the Republican Party right now, and in Trumpism, that sometimes is a bit anti-big corporate, right? We've seen that you mentioned big tech. I think we've seen that in payments a little bit with credit cards. Do you think we are really going sort of back to a much more totally laissez-faire sort of attitude, or are there still going to be areas where it's not easy to get a merger through, where for philosophical or maybe just political reasons, they don't want to see two companies in a certain space merge?
Well, I want to again distinguish horizontal and vertical, because horizontal always was challenging, especially if you're combining, number one and number two, or number two and number three, or the concentration becomes much more significant. That was true even under Ronald Reagan, even during the kind of I'll call it the Bork era. So you just have to kind of level set on that. It was never purely laissez-faire. The second thing is with regard to vertical or other deals that were newly challenged under Biden. I think it's going to vary. You correctly point out there were conservatives that were the typically younger Republican senators that supported the
like Lena conservatives.
Yes,
Sorry,
yeah,
okay,
yeah.
that took me a second. Okay.
I'm pretty sure there was a Wall Street Journal story with
They're
that
probably
title.
I'm sure there was.
So, yeah.
Thank you for reading the journal.
There we go. Yes. So it's definitely on my morning read list. I think that is going to change, except in some areas of technology. Now, the difference in the tech sector is under the Biden regime, it was sort of all tech is bad because it's big and powerful and therefore bad. I think what you're going to see under the Trump administration is much more differentiation. And this is why you see lots of the tech CEOs trying to build connectivity and relationships, because I think it's going to be much more personalized, if you will. Have you acted in a way that the president thinks is, detrimental or not? So it's not a blanket, the whole sector is a problem, but there definitely still are specific companies where it might become an issue.
So you've been in the room with the presidential administration, with Obama. I have to get your thoughts on DOGE, the Department of Government Efficiency. I mean, is there low-hanging fruit there for Elon Musk and Vivek Ramaswamy?
I wish them well. I think it's a worthy task. I think it's much harder to do. It's easy to say, it's hard to do. I still remember when President Obama introduced me as his budget director. It was all about going line by line through the budget for waste, fraud, and abuse. In each administration, there is an effort like this. My experience is that every single inefficiency in government spending is there for some reason. It's there because there's some concentrated group often that has a very, very focused interest in that. And so it becomes very difficult politically to kind of wipe the slate as clean as you'd like.
We'll see how that actually shapes up and where that takes us in 2025. It's certainly going to make for an interesting year, I would say.
Grab your popcorn.
Grab your popcorn.
So we are going to take a final break, and when we come back, we have one last question for
Okay.
Peter Orszag.
Okay.
All right, so just as a last hot take, and by this I mean in like 30 seconds or less, we talked about politics, we talked about interest rates. What is another factor? What is a non-Trump, non-interest rate thing that is going to be the biggest driver of M&A in the years ahead?
Geopolitics. So what happens in the Middle East? What happens with the war in Ukraine? What happens with regard to China? Massive driver.
Thank you so much, Peter. This has been great.
Great to be with you. It's warm in here.
Yeah. Just wait till the questions.
Okay, wow. Thanks for the warning.
Can you turn these lights any hotter? Booth, can you? Okay, all right.